Good morning, Central Florida. Welcome to another episode of Dollars and Cents, where we help you make sense out of all of your dollars that are involved with your investments. We are Central Florida's longest running radio show, also a top 25 financial planning podcast. If you want more details on the radio show or would like to see how you can take a look at some of the podcasts of this show or previous shows we've done, visit our website, nelsonfinancialplanning.com. On the front page, look in the top right. You'll see a variety of icons you can click on, take you to different social media sites, listen to this show and some other shows also. As you might notice, your normal host, Joel Garris, is off today. Got a couple of guest hosts, and so we're going to bring you some great information. My name is Rob Field. I am a certified financial fiduciary and also a National Social Security Advisor with Nelson Financial Planning. To my left is Christina Lamb, also a certified financial fiduciary and an IRS enrolled agent. Good morning, Christina.
Good morning, Rob, and good morning, everyone. We have a big week ahead of us with midterm elections coming up. So those of you who are staying tuned and our clients, Joel's going to be sending out an email probably next Wednesday to go over his commentary on the results of the election. It was also great to see all of our clients at our annual client appreciation events over the past couple of weeks. It's some great camaraderie and fellowship with our fellow clients. So we're also going to be including in that email our fall schedule of events. So we have our a breakfast coming up with American Funds and David Hanna. And then we also have our annual toy and food drive kickoff. So there'll be some more information in those emails. So in the show today, we're going to take a trip down the stock market memory lane. And believe it or not, this has been one of the best Octobers in the history of the market. That's generally not the case. We're also going to touch base on a little bit of the 2003 tax adjustments due to inflation, as well as the Social Security changes. But first, we're going to get back to a topic that Rob and myself broached on the last show we did together a few months ago, which is the top 5 things you might not expect that you need to deal with in retirement.
Thank you, Christina, for bringing that up. We had spent some time talking about, as you approach retirement the year before, 2 years before, trying to come up with some ideas of what you thought would be important as you get close to it. And then as we wrap it up and we come to the point where now it's time to retire, we wanted to sort of address, what are you going to do right when you jump into it? So there is that adjustment period where you're going to go from I work, I earn income, to I'm now retired, and now I've got to kind of look at some other resources for generating my income or how I'm going to spend my time. Obviously, you probably got less money coming in, a little bit, more expenses going out. You probably got some habits you've had for many, many years. You have to address those habits and think in terms of, is this something I can still continue to do? What's going to be my quality of life? Is that more important, or is it going to be my budget? Assumptions you might have made about what you're going to do in retirement as you led up to it might be a little different as you head into it that specific date. Obviously, the first thing you want to do is talk about that budget. You probably thought about it, had discussions, came up with some ideas, moved forward with it. Now we're in the middle of it. Now it's true. What am I got? What do I want to do? Now at this point, you're probably collecting your Social Security. You know exactly what you're going to get from that. At this point, you've got your retirement plan in place. You've sat down, hopefully, with your financial planner and said, okay, here are some specific income ideas we have. Based on where you are right now, this is the kind of income that you can get out. So the key there is that in that transaction is review everything from small things like what am I going to eat, how am I going to eat, what's the cost of food, on up to your housing. This is going to help you determine your true goals as you move forward.
So that brings us to the next item, which is to prioritize your expenses. As Rob sort of touched on, most of us have probably thought about or will think about leading up to our retirement, what are some of the things we would like to do. So those things can include traveling, possibly renovations, healthcare cost, as well as healthcare prevention can all also be costly items. Something that may also come into play is mortgage interest rates. Are you happy with your home? Do you need to try and pay it off? All of those things are important, and we need to prioritize these activities, which will be helpful in creating the keyword, which what Rob said is a budget. And that's something you hear, through retirement planning often, and it's sort of a key word because you tend to be on more of a fixed income once you are on retirement. So you need to make sure that you're planning accordingly, and basically just not doing all these things at one time. So if you want to visit your family up north and you also want to go on your dream trip to Italy, maybe you don't do those two in the same year. Maybe you obviously prioritize family, hopefully first, and then, go take that dream vacation that you've always wanted. So we want to make sure we're prioritizing our actual needs over our wants. And still fitting them in because you do want to enjoy retirement, but just sort of following our wallet first and then our heart.
Good points. One thing that occurs as you go into retirement, you don't want to flip off the switch of saving for the future. You want to continue to think of ways to increase the investments that you have, not dig into your portfolio too quickly. With inflation being, especially where it is today, if you start thinking in terms of, I'm going to use my investments and whittle it down, it's going to whittle down a little faster than you thought. And so you were in a position when you were working to continue to save. You were maybe contributing to your 401k. So now you're not working, you're not contributing to the 401k, but you certainly could take a portion of, say, your Social Security and decide I'm going to save 5 or 10% of that, and I'm going to invest it. And then you're going to try to stay in line with your income so that you're not really digging too hard into your principal. If you do those two things, investments will last. As inflation goes along, if you need to increase what your income is, or if you have some special one-off purchases you need to make, that investment plan will still have a buffer built into it. So we really like to see you think in terms of still keeping your savings hat on. It's very important that you are still thinking growth, and then obviously thinking of the type of investments that would help you to get that kind of growth. All right, we are coming up on our break. Appreciate you tuning in to Dollars and Cents. We'll be back shortly. Hey, Central Florida, welcome back to Dollars and Cents, where we help you make sense of all of life's decisions involving your investment dollars. We're in the middle of a conversation about what happens that first year of retirement. We were just talking a little bit about the budget, making the adjustments and the priorities that you want to keep in mind. Christina, you were going to share another thought with us?
Yeah, so next we have your Social Security strategy. This is important because you need to decide, do you want to take your Social Security at age 62? Or are you going to decide to wait until full retirement age, which is possibly 66 or 67, depending on, where you fall in that spectrum, and knowing the pros and cons of each scenario and how they relate to your personal situation can make a really big difference on, when you decide to take that money from Social Security. I don't know, some of you may or may not be aware that if you start taking Social Security at age 62, there are some earned income limitations of $19,560. So maybe you do decide to retire a little bit on the early side, but then you get bored and you want to go back to work. So those are some things you have to take into consideration when deciding when you want to take your Social Security. Rob is our resident Social Security expert here in the office, and so we'll get into a little bit more of the ins and outs of that later on in the show.
Excellent. I'm glad you brought that up. It is important that you optimize that Social Security with your investments and some of the other options you have, and sometimes starting early can almost limit you. So you do want to have that conversation. Give me a call. We can talk a little bit more about it. I bring that up because the last thing you really want to make sure that you're taking advantage of is the input from your professional financial advisor. Very important that you think in terms of making decisions for the long term, that you're kind of surrounding yourself with the right people. If you decided you were going to improve your health, you wouldn't just grab your neighbor, come up with a quick idea, and then implement it. You would probably seek out help from your doctor or a specialist and say, okay, I need a long-term plan that's going to take me for many years. If you owned a house and you decided you wanted to do some refab on it. You're going to redo your kitchen. You want to update your bathroom. You're probably not going to just grab the local handyman and do a one-day job. You're going to grab a contractor and you're going to say, okay, here's the things I want to achieve over the next few years. I need you to help me get there. Same thing happens with your investments. Just because you've retired, it's now time to take income. You don't just start hitting your investments and see what happens. You grab yourself a financial professional who specializes in retirement planning, long-term investing. You want to make sure that you're grabbing somebody that has your best interest in mind. You don't want to just get a stockbroker. You want to find somebody that's going to help you make everything work together. I bring that up. You're going to really want to find somebody that works in your best interest. That's a certified financial fiduciary. We are all certified financial fiduciaries here at Nelson Financial Planning, which means that anything we recommend to you, it's in your best interest. Not just suitable, but it is in your best interest. So keep that in mind. I'll also tell you that anything we recommend to our clients or our prospects, we purchase the same investments. So we have your best interest in mind. We're also in the exact same boat you are and investing in the exact same way. So keep that in mind. Get professional help. Continue to get that professional help as you move forward through retirement.
And basically, we don't want to just do everything necessarily in our first year. We want to put our plan together and start to accomplish some of the things we want to do in retirement little by little. We want to take some time to savor the special moments and trips that we may do, or spread out activities and make things less stressful and a little bit more meaningful. After all, you are in retirement. There is no need for pressure, whether that be financial, emotional, spiritual, whatever the case may be.
Excellent. So moving on, I wanted to share with you a couple of ideas about, what happens in the market. I'm going to take a look at, kind of shift over and talk about market history. I'm going to share a couple of days with you that I find interesting. Some of these days may sound scary, so my goal here is not to try to get you worried about the market, but just to let you know that even under the worst or some of the worst days in the market, follow up, you end up with some great returns on an average basis. So I'm just going to share a couple of days with you. The one that most people kind of think of first is October 28th, 1929. That's the beginning of the Great Depression. The market had a nice, fairly large collapse. It was called Black Monday. It was down about 13%. At that point, going forward, the market ended up losing about half of its value. So that could be a little concerning, but we move forward.
Quite substantial decline there.
That's a big
half
decline.
Would be quite a scary thing for one day.
And at that point, the market hadn't been around that long. Mm-hmm. So people, you're trying to explain to them this new great idea of having companies that go public and you can purchase into it. And then short time later, you got the market doing a large pullback.
I believe we haven't had a decline like that since then.
No, nothing quite that dramatic, because it leads into the next day, which would be the fourth worst day ever. That's October 29th, 1929. Another 10% goes down. This is where we start to this is what led to the Great Depression, and unfortunately, for many, many years, the market kind of continued in that level. The number one day where the market had its lowest return would have been October 19th, 1987. It was down about 20%. This was caused, a lot of things were going on. Stock options were very prevalent. There was derivatives in place that were really not being regulated. There were a lot of foreign investors had come over to the United States to take advantage of the market, because previous to that, the market had really been producing some really strong returns. And so, that led to a couple of reforms. We ended up getting some mechanisms in place that actually could stop the market on certain times if it hit a certain stopgap, and that sort of kind of improved the automation of what the market was doing. Another date I was going to share with you, and this would be the 11th worst day in the market, and we're kind of going chronologically. September 29th, 2008. This is a date now that a lot of investors are familiar with. This is, at this point, the housing market had gone crazy. It was almost time, hopefully, for a bailout, and actually the House of Representatives decided, no, we reject it. We're not going to do this big bailout. And the market reacted pretty strongly. And it came to what a lot of people are referring to as the Great Financial Crisis. Market dropped down that day about 9%, continued to decline. And for a period of time, it's kind of hovered down in that low number. And a lot of people remember that. A lot of our clients are telling us, in 2008, I lost a lot of money. I can never do that again. Of course, you don't lose in the markets unless you actually sell. One thing I'll keep in mind is from that bottom of 2008, the S&P is up 400%. So we've seen a 400% rise since that bottom. Now, the bottom was tough, and if to buy and hold and to stick through it, it can be rough. But again, the point I'm trying to make is that even on the gloomiest of days, you will find over time the stock market gives you some great average returns. Last one I'm going to share with you is the number 3 as far as having the size of a down day. That's March 16th, 2020. This is when COVID started to hit, and then the market started reacting, and they started realizing, okay, this isn't just a small flu bug that's going away. This is going to be with us for a while. We started seeing layoffs in the market. We started seeing lockdowns where people were stuck at home. People wearing the masks and things like that. And so, from during that time of COVID, the market dropped down a total of about 34%. That day was 12. We added in some others as it kind of beat itself up.
That was one of our quickest down markets, if I recall correctly. It was
Correct.
Down and up very quickly, not like a normal situation you would see.
Exactly. Great point. We're coming up to a break. We're going to wrap up this conversation on the next episode. Stick with us. You're listening to Dollars and Cents here in Central Florida. Welcome back to Dollars and Cents, where we help you make sense out of all of life's decisions involving your investment dollars. I'm Rob Field with Nelson Financial Planning. To my left, Christina Lamb, also with Nelson Financial Planning. We're hosting today for Joel Garris. He will be back next week with the next episode of Dollars and Cents. Previous to the break, we were talking a little bit about stock market history, and I gave you some examples of some days that seemed a little scary, and I wasn't really trying to put fear into the investor as much as to say, here are some examples of some tough times in the market, and yet we have still rebounded nicely and gotten some great average annual returns. If you had been listening to the show 2-3 weeks ago, Joel Garris mentioned a statistic I think is very interesting. The stock market goes up 53% of the time. It goes down 47% of the time. So that means out of 100 trading days, only 53 of them are positive, 47 of them are negative. So that seems a little scary. Why would you want to invest in something that is up and down, and you don't really get that kind of performance that you would want? The key, Christina, as you know, is that the up days outweigh the down days.
Yes, absolutely.
And the only way to get those positive days is you got to be in the market and stay into the market.
I think what's an interesting fact around that is some of the biggest up days are surrounded by the worst days. Correct. And so, that's why as here we try and encourage clients and sort of teach them that staying in the market is generally the best strategy for you.
Agreed. It's funny how, it's the darkest before the dawn, where you'll talk about a day like you just described where, hey, that was a great day in the market and we've had some really down days. The previous day to that will be really scary. People will be like, there's just no way I'm going to get in the market. And they've been out for a while. There's no sign that tells them to get back in. And that's why the whole buy and hold strategy works. If the numbers are good. I mean, if the average annual numbers are strong and you buy and hold, then certainly you should do that. So let's take a look at a couple of sets of numbers. The S&P 500 over the last 20 years has averaged 7.5% average annual return based on the underlying stocks, the 500 companies. If you could take those dividends and reinvest them, which is a little harder with individual stocks, but if you did, your average annual return actually jumps up to about 9.5%. Now, if we look at the 100-year average, go back and now we're pulling in the 2008s and COVID and the Great Depression and everything that's occurred in between, 1987, you'll find that the average annual return over a 100-year period for the stock market is 6.2%. Not a bad number. If you can reinvest your dividends, that gets that total return up to about 10.3%. I like to talk about reinvesting those dividends. It's a little difficult with individual stocks. The dividends generated, it's sent to you. You got to take that money. If you want to reinvest it, you got to go back to your broker, buy more stocks. If you were to own mutual funds, you can have your dividends automatically reinvested at no cost to you, and you don't have to do anything other than just say that's how you want it done. So companies generate these dividends. You take them, reinvest it. Not only is the company growing, but then the dividends are going to help your growth also. So we talked a little bit about that. The thing that I also want to let you know is that, and I think we were talking about this just yesterday, in October 22, the stock market the Dow Jones actually had its best October in the history of the market, up a little over about 11%. That's the highest October we've ever had. And again, we're in the middle of what a lot of people consider a bear market, which is true. We're still down about 10%, but we have been down as much as 22%. So we made up 10 of it just in 30 days. Had a client in here yesterday, and we were telling them that. And they had no idea because it happened so quick. They had seen their September 30th statement, and they came in for a review, and they were shocked that in 30 days the market had gone up 10%, made up some of that. Also, that 11% in October is the best for any month we've had since 1976. So these are some positives that even though we know that there are some tough times in the market, you still get some great returns when you kind of step back and look at it.
I think
a
that
little bit
just
longer.
goes to show, why we encourage clients to stay in the market and long-term investing. While a year itself, or even 2 years, may not be what you want to have in the performance of the market, over time, as you were going over those stats of the S&P 500, its rate of return is quite significant. And considering the inflation that we're having right now, one of the best bangs for your buck if you want to keep up with inflation and make some money on your money.
Right. Bottom line, buy and hold quality, trust that what you own, listen to your financial planner, you'll be fine.
Wonderful. So next is our tax segment. The IRS has provided several inflation adjustments for the upcoming 2023. Now, don't expect those adjustments to be anywhere near the actual rate of inflation. However, a little bit is better than nothing. So there were over 60 changes, but we're just going to hit on a couple of them so we don't bore you. The first is one that we haven't seen in a while, which is the increase in the IRA and Roth IRA contributions. It's gone up $500 this year. So if you're under 50, you can put in $6,500. Or if you're over 50, there's an additional $1,000 catch-up amount. So that would be a total contribution for the year of $7,500. Now, one thing I like to point out, I don't think a lot of people realize, is you can also make spousal contributions. So let's say you're in a family where one of you is working and one of you is staying at home. Now, the person staying at home, they can make what's called a spousal contribution potentially if their spouse is working. So that may be another way to help you get a little additional savings for retirement. We also have adjustments to the 401k, 403b, 457s. Those are all kind of grouped together. The annual contribution amount has gone up by $2,000. So if you're under 50, total contribution into your 401k can be $22,500. And if you're over 50, there's a much bigger catch-up amount of $7,500. So that means that you can add in a total of $30,000 to your 401k plan for the year. So these retirement contribution changes can make a big significant change in how much you're saving for retirement. Boosting your contribution by just 1% a year can make a difference, especially when considering you're going to be investing for 10, 20, possibly 30 years. So 1% is a smaller amount, and that can be helpful by making smaller changes at a time, so you see a consistent pattern with how much you're investing instead of stopping or dropping that amount. If you make smaller adjustments, it's going to hopefully keep you as a more steady investor. So these contributions will be beneficial to you in the long run. So what I like to talk to clients about sometimes is, let's think about when you get a raise. So if you get a raise, maybe take that a portion of that and add it to your 401k, because in essence, it's sort of money you didn't have. So as you move that over to your 401k, you're not necessarily going to notice that it's not there. So that helps boost up that amount. So we don't want to forget to also let our tax preparers know if we are making IRA contributions. So IRAs work a little differently on the tax reporting side. 401ks are denoted on your W-2, and most people know to give that to their preparer. Now, when you make IRA contributions, that is not necessarily the same case. So you either need to provide them with your IRA statement, or you want to give them, let them know that you're making those IRA contributions so you can be sure you're getting the tax deduction on your return. Now, for Roth IRAs, there's also a saver's credit. And it is for lower income amounts. However, it may still apply in your situation. So even though a Roth IRA itself is not tax deductible, there may be some other tax credits that would be available to you. So you just want to make sure you're having that level of communication with your preparer. We also have some of the more common adjustments that we see every year. So the standard deduction is up about $1,800. So for joint filers, that's $27,700. For single filers, it's up $900, which brings you to $13,850, and then another $1,400 for head of household. Marginal tax brackets have also increased. The lowest bracket still remains at 10%, but the level it's taxed at 10% has gone up. So that is $11,000 and under, and for joint filers, that's $22,000 and under. The highest bracket remains 37%, which for single income is $578,000, and for joint filers is $694,000. Personal exemptions still remain 0.
That's a lot of information there.
I know.
It makes me want to just
hand it off.
Yeah, exactly. And thank gosh I use a tax planning professional for that. We're wrapping up this segment. Be back with you shortly. You are listening to Dollars and Cents here in Central Florida. Welcome back to Dollars and Cents, where we help you make sense out of all of life's decisions involving your investment dollars. As you know, Joel is out this week. Christina and I are stepping in as your guest host. Christina was going through some things that are going to be changing 2023 for the IRS and the tax codes, and let you kind of give us a few more of those, and then if you'd like, we'll switch over to Social Security, one of my favorite subjects.
Sounds like a plan. So the last section I had was a little bit of specialty tax rules. So these are not situations that are necessarily going to apply to everyone. However, some people may be able to take advantage of them. The first is the annual gift exclusion. That has gone up $1,000 for 2023. So that brings it to $17,000 per year. So this is the amount that you're allowed to gift to an individual, and the transaction will be tax-free on both sides. So the person giving the money doesn't have to pay taxes on it, and the person receiving the money doesn't have to pay taxes on it. This is a strategy we see some of our retirees use if they possibly want to give some of their beneficiaries some extra money before they pass. Instead of, waiting until they're deceased, maybe they can get some enjoyment out of it earlier on in life. Next is the estate tax exclusion. So that has gone up almost $1 million to $13,000, which is quite surprising. This has been a highly discussed issue this year about decreasing the amount or changing the way that works. So they did, in fact, go ahead and raise that for 2023. As of now, obviously, all of these are subject to change whenever I kind of feel like it. The adoption credit has gone up for qualified expenses, $1,000, so that brings it to $15,950. And then also the foreign earned income credit for those who work overseas but still may be based in the U.S. Has gone up about $8,000 to $120,000. So as you see, we see a lot of these figures adjusted, maybe a little bit more than usual due to the inflation that we're experiencing. And as well, we've seen Social Security be adjusted for inflation. For 2023, the expected amount is about just a little under 9%. So we're, I don't recall Social Security being adjusted that much in I guess, the recent past.
Sure. No, Social Security has been always lagging as far as cost of living adjustments. Last year, they bumped it up to about 6%, which was a big number.
Mm-hmm.
Hadn't been like that since the 1980s. And then, as we've mentioned before, in the last month, the government has decided that the cost of living adjustment is now going to be 8.7% going into 2023. If you add those two up, that's about a 15% increase in income coming from Social Security, which that income does get applied directly to your tax statement, right?
Yeah, absolutely. It'd be nice if we all got an increase like that.
Exactly. Yeah, Garrett was talking about, go talk to your boss about, inflation. And I was like, slow that down. That's not really what we want to be chatting about at this point. But yeah, it's so important that people are aware of the changes coming up, be it Social Security or taxes. And I think it's just a great emphasis on the fact that talk to somebody that knows what's going on, because with all those different caveats you're talking about, you can't just on your own do your normal 1040 and take advantage of some of the things or be aware of everything that's moving on, especially with Social Security. As more and more people are taking Social Security and that income comes in, it is possibly going to bump you up to a different tax bracket. You need to know how to handle that. There's some other things you can do to offset. I think you got to work in your adjusted gross income, so it's not just black and white. Using your tax professional is certainly going to help. So on Social Security, let's talk about some other things that are going to change in 2023. So we know we had a 5.9% increase 2 years ago. Going into 23, we're going to have the 8.7, about a 15% increase. You'll see that in your first check going into January 2023. Even if you haven't started to collect Social Security yet, if you start looking at your estimate statements, and again, I can't emphasize enough about going to ssa.gov, set up your online account, you'll see your estimated Social Security. Even if you're 60 right now, you don't think you're going to take Social Security for another 10 years, the estimates will show the cost of living adjustment in your predicted payout. So even though you're not collecting Social Security, you will also get the advantage of the cost of living adjustment. Social Security is funded by a couple things. They do have their large $2.5 trillion bond portfolio. The interest off that helps to fund some of the benefits people get. It also, as many people know, if you have a job, they're taxing some of your income on each person, 7.65%. Employer kicks in another 7.65. That number's the same, but the amount that they're going to tax has gone up. Last year was $147,000. Going into 2023, the amount will be $160,200. If you make less than $147,000, you won't notice a difference. But if you make more than $147,000, you'll see a little bit more of your income taken away and applied to Social Security. We appreciate that. People like myself who are closer to retirement, you're doing me a favor. But keep that in mind. There's always been a banter also, and President Biden likes to talk about maybe having an extra layer. People that make $400,000 or $500,000 might kick a little bit more. But as it stands right now, it is capped at $160,000. So if you're making more than $160,000 and have been for a period of time, you won't even really notice much of a difference. Same thing, Christina mentioned a couple of minutes ago about the earnings limitation. So if you are under full retirement age, which will be if you're born in 1960 or later, that puts you at 67. If you're born in the 55 to 59, it's 66 in a couple of months, and so on and so forth. But the majority of people in the next few years, as they move along, their full retirement age is going to be age 67. That's a lot of people are thinking about taking retirement or working part-time or collecting Social Security. You do want to be careful about how much you make in addition to your Social Security, because it could be reduced. As Christina mentioned, some of the numbers for next year will be $21,240. If you're under full retirement age and you make more than that in your outside job, Social Security will pay off about $1 for every $2. If you, by the time you hit full retirement age, so let's just say you're born 1960 or later, at that point, that year that you turn full retirement age, you can make up to about $56,000. That increased. And then the month you turn full retirement age, so if your full retirement age was 66 in 10 months, at that point you can earn unlimited income and not have Social Security reduce at all. So just keep that in mind as you're making your decisions. A lot of people think, well, Social Security, I'm not sure how long I'm going to be around. I'm going to start as early as I can. And they end up giving a lot of it back. Yeah, you want to keep in mind that once you apply for Social Security and you start collecting benefits, you've locked in that number. Other than maybe the cost of living adjustments we were talking about, right, that's your number. So don't get confused and think, well, every year it goes up automatically. That's only the cost of living adjustment. So don't start Social Security and then have it be reduced in half, and then you're paying the price for a long period of time.
Yeah, that's quite a steep penalty if you retire early and then make more than the allotted earned income. I mean, 50% of that is 50% of the overage. That
right.
is quite substantial.
Right. I mean, you could end up, if you run the numbers, you could say, well, I'm not going to make that much. I'm just going to make a $40,000 job, and you'll find that you'll end up maybe getting 1/3 of what you would have gotten from Social Security. over that gap. So think it through.
Yeah, I think that's one of the things we talk to clients about too, and make sure they're educated on knowing the decisions between retiring early and what that means income-wise, and maybe they work less than they anticipated just so they're not receiving that penalty.
Correct. I mean, that's a good point. You just want to run the numbers, give us a call. We can help you kind of do some estimates. I thought I'd share some of the popular ages when people are actually applying for Social Security. You would think 62 would be the number one, but that's the second most popular time. And think of it in terms of if people are going to start collecting Social Security, they're typically looking for a little bit more. The number one age where people are applying for Social Security is around full retirement age. Just based on what you and I were discussing, you're not going to be limited to your income. You will have gotten higher benefits than if you started at 62. 62 is probably the number two choice for people to start collecting benefits, and that's typically somebody who's like, look, I'm out of work. I'm not going to be working. I'm not worried about the estimates. And then, of course, number three would be full retirement age plus, which would get you to 68, 69, and 70. So just some fun facts to know there. We've got other things we can share on Social Security. Always feel free to give me a call. You are listening to Dollars and Cents here in Central Florida. If you heard something you like, give us a call. We do have live people answering the phone, 409-407-629-6477. Keep in mind, we also do not have account minimums. We want everybody to get a chance to have a successful financial plan. Enjoy the rest of your weekend. Talk to you soon.